Today, we're over in New Zealand, where Dr. Michael Rem, a senior lecturer in property at the University of Auckland, was recently quoted as saying buyers and sellers are starting to get the impression that house prices in New Zealand do not always go up. We are finally breaking down that long-held belief, which begs the question, will the latest rate cut, as announced this week, change that tune? Because on Wednesday, New Zealand's Monetary Policy Committee reached consensus to reduce the official cash rate by a further 50 basis points to just 2.5%. And they said they remain open to further reductions in the OCR as required for inflation to settle sustainably near the 2% target. That's the midpoint in the medium term. The Reserve Bank in New Zealand was always going to cut the official cash rate at this meeting, although markets and economists were somewhat divided on the likely outcome, with the weight of opinion slightly favouring a 25 basis point cut. The underlying theme is the spare capacity which is building in New Zealand's economy, with a sluggish read on the economy, which explains the consensus decision this time compared with August, when two members dissented for a 50 basis point cut then. Now, it is true that the considerably weak second quarter GDP result was thanks to an unusual set of noise in the system. And it's worth noting that the New Zealand third quarter GDP nowcast is up 0.7% over the quarter. And there's an improving read from Stats New Zealand's activity index as well, which could suggest that the economy is not so weak as the committee is reading it. We'll see what emerges when the third quarter CPI and the third quarter labour report are released ahead. But clearly, the bank is expecting continued weakness amid wider geopolitical and economic uncertainty, which pushes down on medium-term inflation. By the way, on inflation, the committee pointed to a more resilient global economy, gradually waning uncertainty, and a weaker New Zealand dollar to support New Zealand exports, all potentially leading to, guess what, higher inflation. But on the other hand, the current resilience observed in the global economy is largely related to AI-driven investment growth, they said, particularly in equity markets. So it's not clear how long this would be sustained. And the Reserve Bank of New Zealand assessed that global resilience this year may represent a difference in the timing rather than the extent of the negative impacts of trade restrictions on growth. So all up, it seems the Reserve Bank of New Zealand's assessment of global growth does remain muted, albeit modestly higher, with actually net little inflationary pressure near term.